So like I said, today we're focusing on chapter 30, which focuses on government budgets, fiscal policy, and looking at these two things. The first little bit we'll get into today looks at how governments spend and how they make money. So spending and taxation. Spending will be, again, expenditures, or they are the G from our GDP. Taxation is going to be the government source of revenue. That is, they charge taxes. And when we talk about taxes, we'll talk about these in a couple ways. That is, we're going to include one, your traditional taxes, but also if you face a fee from the government. So if I go out and I get a speeding ticket, for the sake of this chapter and for the sake of budgets and fiscal policy, we would consider a speeding ticket a form of taxation because it's money that's going from you to the government in that case. That's what we have there. Point 3 looks at a difference between the federal deficit and the national debt. We hear about this a lot in every election year, so we hear about the debt, the deficit, and we hear these two phrases or buzzwords thrown around a lot. So we'll look into that. Point 4 looks at how we can use our fiscal policy to fight recession, unemployment, inflation. So last week we talked about expansionary and contractionary monetary policy. This week we'll talk about the same thing, just with fiscal policy. Point 5 is automatic stabilizers. These are going to be things that kind of kick in automatically when the economy is doing bad or well. In the point 6, we'll see some issues. So we passed this policy, right? And we'll see some issues that actually come up with fiscal policy. And it's great that we passed this policy, but how might the policy not work the way we want it to? Last week, when we were talking about monetary policy, we said that potentially banks don't have to loan out all the money that they are necessarily supposed to, or they don't have to be right on the reserve requirement. Same thing with fiscal policy. We may see some issues come up that, we mean for it to be well. Maybe it doesn't get used the way it's supposed to, or maybe it takes too long to get there, whatever the case is. Then point 7 looks at the issue of a balanced budget. Every so often we hear, the government needs to run a balanced budget. We'll look at the advantages and disadvantages of that argument and kind of see how that works out. So we can start out with government spending. That should be this first part. So when I think about government spending, a couple words we hear sometimes. There are kind of three places our budget can be. The first is going to be called a budget deficit, and this will be when we spend more than we receive in a given year. That is, our expenditure or our expenses are greater than our revenue, i.e., our spending is greater than our taxes. So if the government, say, spends $3 trillion this year, but they only bring in $2 trillion, we're going to consider to run a budget deficit of $1 trillion. The opposite of a deficit is going to be a budget surplus, and this will be just the opposite. We ended up receiving more money than we take in. So in this case, our revenue will be greater than our expenses, or the other way of phrasing that is taxes are greater than spending. So in this case, maybe the government is able to bring in $4 trillion of taxes, but they only spend $2 trillion, in which case they're said to run a surplus because they essentially have a surplus of funds at the end of the year. Then the third case, if we have a case where we have greater than, less than, the third case is going to be when they're equal, and this is called a balanced budget. So in this case, we spend what we bring in, and we bring in what we spend. So our revenue, in this case, is equal to our expenses, or taxes are equal to spending. And again, that is our balanced budget scenario. So when we think about where's the federal government spending, and again, at this point, we're talking about federal government. We'll get into state in a little bit, but first is federal. The big things that we're going to see the federal spend on is national defense, which is our military, so or our armed forces. So Army, Navy, Marine, Air Force, Coast Guard, that kind of stuff. Social Security, and Social Security will be it'll be both a retirement plan that you have to pay into, but it's also going to be a disability insurance. Right. So if something happens where I'm no longer able to work, or if any of us are no longer able to work, we may be eligible for Social Security. In this case, we may have hear it called disability. So if I'm on disability, this means that I'm not able to work because maybe maybe I have something physically that prohibits me from going, or whatever it can be. It can be. But I have this disability. I'm no longer able to work, so I'm able to draw disability and uh, be able to live, get paid, even though I'm not able to work. When we think about health programs, the two big ones that we hear about are Medicare and Medicaid. And with these two, these are looking at. So we have Medicare, which is your insurance for your retired crowd, pretty much. So when you're old, you're able to draw Medicare. Again, kind of like Social Security, you pay into it all your life. Once you're old, you get to receive it. We also have Medicaid, which helps with your low-income individuals, or your low limited income families. So again, these provide health care for those who are on those payments, and the last or those situations. And the last group is our interest payments, and these will be on our national debt. So right now we have, at this very second, let's see how much debt we have. At this very second, we have $24.2 trillion in national debt. So with this national debt, we have to pay interest on it. Just like if I have a credit card that has a balance, or I have a mortgage payment or a car payment, I have to pay interest on my loans. Same thing with the government. They have to pay interest on their loans. So that is what we see. And just for reference, just because it's interesting, or maybe it's interesting, maybe not, but oh well. Our budget, the way kind of our budget is working, and really where they are, national defense, at least in the U.S., is $686 billion. Social Security is about 1.0, or I'll do $1.07 trillion. Our Medicare, Medicaid healthcare programs are going to be about 1.27 trillion. And we're paying, or this year, we're going to be paying $381 billion in interest. So this is kind of where our federal government spending is. Again, these four categories, they all map out to each one of these. And this is from the debt clock as well. Again, US Debt Clock, really cool little website. You don't want to take and say, oh, these numbers are, 100%, carve them in stone and place them on and put them anywhere. It's like, that you have to have a solid number for. But if we're talking of estimates, and kind of like we are right now, it works pretty well for us to see where we are. Since the coronavirus has started coming through, it's not like they're just, and to some degree they are set on a formula versus time, but to another degree they do get adjusted. So currently, while everybody is, or while a lot of people are not working, our GDP, according to Debt Clock, has started to go down, which in the real world right now, we probably expect it to, because the only thing we're getting out and doing is grocery shopping, whereas before we would get out and do a lot of things. And it has debt going up, but that's always going up. So that's that. So these are major areas where the federal government is spending their money. So the federal government has to get their money from somewhere. And to make that happen, we'll come back to that in a second. And to get this money, they're going to do what's called taxes. Right? We're all familiar with taxes, and we've all paid them. Even if you don't pay an income tax at this point, you've probably paid sales tax. You pay, maybe you've paid it, depending on where you've been in life, meaning physically where you've been. Maybe you've paid a toll on a state highway, or maybe sales tax is probably the biggest one. But you maybe have like when you got your first paycheck ever, like in your life, you said, "Oh yeah, yay! I'm making like $400. I'm so excited," and you expected to have this, say $400, but then you got the check and it was like $275, right? So you kind of had that little disappointment where it's like, "Oh, a decent amount of my money just got taken away by the government," and that's what we see with that. So when we're looking at this from the federal level, we're seeing a few main types. First kind of tax we see is called our income tax. And this is a tax that, originally, so before they extended it, this is the tax that today would have been tax day for, April 15th. Every year you file every year from your employer, you get your W-2s. Then with your W-2s, you file 1040, and you have that income. Maybe you have a 1099 income for contracted work. But as I work, I pay some share of my check goes towards this federal income tax. And we also have state income taxes, but right now we're focused on federal. So again, we tax our income that's received by individuals. And for the most part, this is all forms of income. So currently I have work with DMAC, but then I also have work with, some contract work that's a 1099 income that's not like an employer job, but it's just a little bit of a side gig, right? So with the side gig, right, you have, in this case, the other place that you're working for, they don't have you on payroll. They don't provide any benefits to you. Instead, they pay you as if you were a merchant or an independent contractor, is what the technical phrase is. So in this case, even though my check from this other place does not get taxed when it gets sent to me, that is, if I make $500 extra this month, I receive a $500 check, I'm still responsible for the tax that comes with that income. So this is all forms of income. If you invest in the stock market today and you hold it out for a year and you gain some money doing that, you put your money in the stock market today, and then a year later you have growth and you sell your stocks. In this case, you'd have to pay a capital gains tax on the income generated from those stocks. So again, income tax is paid by individuals of all forms of our income. A few exceptions to this. So if you are receiving a coronavirus stimulus check, it will not count as income, just because that's kind of thought of as more of a tax rebate, not so much a source of income. So if you're receiving $1,200 sometime this week, or you have a check coming in the mail, that would not count as income for you in terms of your income tax. And the idea of that, again, is that this is from the way that we're looking at it, this stimulus check is going to be seen as a tax rebate. That is, you paid your taxes, now you get some of that tax money back. The second part is your payroll tax. And this will be, and we'll kind of look at this in a second, but this, we're going to see a tax that's paid by your employer. So two common payroll taxes we see. our Social Security and Medicare, or at least they're at least partially payroll taxes. But yeah, we have these payroll taxes. Again, I do not pay the payroll tax, my employer does. So when we hear about, so again, and this is really a perfect time to be doing this chapter because so much of this has been in the news lately. So a couple things that have happened over the past month. First, your federal income tax and your filing, as well as the Iowa state tax, the due date for the tax and the due date for filing has been pushed back to July 15th. So when they're referring to that, they're talking about your individual income tax, right? When I have to make sure that everything's in line, it has to be done by July 15th. The other thing that's been talked about has been a waiver or a deferment of payroll taxes. And this is the part, again, that's covered by the employers. So what they're saying is we're going to give the employers a little bit of a break to give them an incentive to keep paying their workers. Or to try and keep workers on the clock, or maybe keep more people on, or whatever the case is. And when we see our tax system, we have what's called a progressive tax. That is, and the general overall idea of a progressive tax is that those who have a higher income are going to pay a greater share of the tax than those with lower income, or they're going to share a higher percentage of their income, whatever the case is. So we see all this stuff, but we wonder what this is. So, so every week, other week, month, however often it is, you get a check, and if you actually look into it, you're going to see a couple parts. So the first part is going to say your earnings. Right, and this will say, right, you'll have some dollar amount. This is how much money you made. But then underneath that, you have your deductions. Okay, you have your deductions. It may also say benefits and taxes. So we have this second column here, benefits, deductions, taxes. So maybe you receive some sort of benefit. So suppose that you have a health benefit that comes directly from your check, and maybe you pay $100, or excuse me. So within this last section, you're going to see two columns, probably four columns, but I'm going to stick with the first two because the second two will be annual. But you're going to have an employee column and an employer column. Okay. So your employer is going to say how much you paid to these individual things and how much they paid to all these different things. So the first things we may have is something like your benefit. So say you have a health benefit, and on your last check, maybe you paid $70 while your employer paid $180. Right? This means that after you have your income, right? However much it is you have in earnings, your $70 of what you earned is going out of your check into your health insurance. After that, you may have something like a federal withholding. So basically a federal income tax, then a Medicare, then a Social Security. Okay. And Social Security can be phrased however we want to phrase it, but it's there. And then you may also see something in Iowa income. Right. So just some things we may see, or whatever state you have as that. So more than likely you're federal, and I'm going to break these into percentages just that way I don't that way we don't give out personal information by accident. But with our federal income, what we're going to see is that you pay this 100% from your check. So if your check says before So if you earned, say, $500 this pay period, then whatever the federal income is being directed 100% uh, deducted from that $500 that you made, and then your employer doesn't pay any of your income tax. When we get into our Medicare, we're going to see something like a 50-50. And again, this is supposing that everything is accurate with the way that the college does their stuff. So in this case, 50-50. So 50% of this is a tax to me. So 50% of my Medicare bill gets deducted from my $500, but the other 50% is paid for by the employer. So I make $500. This 50% on the right does not get deducted. And same thing with Social Security. Um, we're seeing a 50-50. I thought that one was different, but I guess not. So we have a 50-50. And again, 50% of that is coming from my check. 50% of that is not included in the earnings that I have. And then for the Iowa income, this will be, again, 100 and 0, because that's an income tax. So we have our different taxes. And again, this Medicare and Social Security, at least these two parts, are going to be what we call our payroll taxes. Whereas all of these parts would be considered an income tax. Right? They're based off of our income. So with our tax system, right, we talked about the progressive tax, and within the progressive tax, what we have is called the marginal tax rate. And basically what this says is that the tax rate that I pay is based off of the last dollar I earned. But as I earn more dollars, the last dollar has a higher tax rate. So just an example of this, we have this table that shows 3 levels of income: $0 up to 9,075, 90,75 up to 36,9, and 36,9 plus. Okay. And we have these 3 marginal tax rates. So for calculating different tax bills, and for the sake of this example, we're not worried about standard deduction. We're not worried about any deductions. It's just you take your income, and that's what your tax is based off of. So if we have a couple examples, suppose first that we have an income equal to $5,000. Then as we calculate our tax bill, what we'll do is I'll take this 5,000 puts me into this top, or we would call that a bottom bracket, but it leaves me in this 10% bracket. So my tax bill now will be equal to 10% or 0.1 times that $5,000. So this individual owes $500 in taxes. The second example I have is an income of that's a $500 tax bill, and then their rate, or what we may often see is their effective tax rate, will be equal to this 500 divided by the 5,000 they earned, which in this case would be 10%. Really nothing too surprising with this first one. However, for the second one, we have a case where income is, say, 15,000. And in this case, our on this case, we're going to fall into the second bracket. So what we're going to do is we're going to tax the first $9,075 onto this part, then the remaining in this 15% bracket. So to calculate this tax bill, we'll take 10% or 0.1 times the first 9,075 Then we'll take 15% or 0.15 times the remainder. So we have 15,000 minus 9,075. And this will give us 907.50 plus 15,000 minus 90.75. That comes out to be 0.15 or 15% of 59.25. And this comes out to be $888.75. So we have 907.50 plus 888.75. Then if we add these two together, we have a total tax bill for the second individual equal to $1,796.25, which gives them a rate would be equal to that 1796.25 over their 15,000. And this will give them a tax rate of 11.9%. So the person who made 15,000 paid a higher tax rate than the person who made only 5,000. And then our last worker that we can reference is, what if in this case we have an income equal to 50,000? And we'll kind of just do the same thing. So their tax will now be equal to 0.1 times 90.75 plus 0.15 times the second bracket is from 36.9 to 975. So I'll take the difference of those two. 36,900 minus 9,075. Then they'll get taxed 25% or 0.25 times 50,000 minus 36.9. So what this will give us, 0.15 times 36,900 minus 90.75 is 27,825 plus 0.25 times 50 minus 36 is 13,100. Then they have that starting one that we'll just carry down. So in this case, the tax bill for our high-income individual will be 907.5 plus 0.15, 0.15 times 27825. So this is 4,173.75 plus 0.25 times 13,100, 32.75. So now if we add all of these together, we'll see that this third individual's tax bill we will expect to be plus 907.50. We'll expect their tax bill to come out to be $8,356.25, which gives them a tax rate equal to that 83.5625 over their income of $50,000, and this gives them a tax rate of 16.7%. So again, as our income rises, a larger share of our income goes into the tax. But with the marginal tax rate, the only dollar that you pay the highest rate on is the last dollar. So any dollar over 36.9 is taxed at 25%. So that first 9,000 is taxed 10%, whether I'm me, Bill Gates, or a high school student, right? For everybody, that first $9,000 comes out to be taxed the same. Now, granted, in the real world, we have deductions, we have all that stuff, which makes tax law a little bit more interesting. But a really nice, straightforward example of what we have so far. So, moving on, uh, some other taxes that we see come up, or that could be done by the federal government, that uh, it could be done by the federal government, it could be by the states, but different kinds include a proportional tax. And this is going to be some tax that has this, we say it's going to be a flat percentage of income regardless of your level. So in this case, we might just say that everyone pays 10%. Right? Everyone pays this flat rate, whether you make $1 billion or you make $10, you pay 10% of your income, or whatever your favorite percentage is. An example of this is going to be our Social Security. Right. So Social Security, Medicare, pretty much up to a certain point, everybody pays the same amount on it. It doesn't matter if you make $1,000 or $10,000. We all pay the same amount or the same percentage of our income goes towards Social Security. The second or third type of tax we may see come up is called a regressive tax. And this will be one where people with high incomes actually pay a smaller share of their income in a tax. A big one that we'll see with our regressive will be an excise tax. So if we think about something like smoking, right, or cigarettes, and there are taxes on cigarettes. Now, if you smoke, you smoke, right? And odds are, if you're a smoker, you probably smoke, say, a pack a day. I'm just using that as a rough estimation. If you smoke a pack a day, odds are that if you made an extra $100,000 a year, you would still smoke the same amount, right? Just because if I made an extra $100,000 a year, I'm not going to all of a sudden say, oh, I have so much more money, I'm going to smoke 3 packs a day now, right? If you are a smoker, you're probably going to smoke the same, whether you make more money, less money, or whatever the case is. It's probably not going to change. So with that, since you don't change your consumption, you don't change how much of a tax you pay. So both a poor smoker and a rich smoker pay the same excise tax. So they pay the same value of a tax, which is a higher percentage of the poor smoker's income. So you have what's called a regressive tax. Another one we have, and we have 2 more that we're gonna kind of get into. The third one on this page, or we have a few more we'll get into. A couple of them are levied by the state. But third one we see is called the corporate income tax. And for this, if you are a company and you make profits, we charge a tax on it. With this though, we want to note that we tax profits. Right, so if I go to McDonald's and I spend $1 on a sweet tea, McDonald's does not have to pay a tax on the full dollar. Instead, they just have to pay a tax after they pay their workers, after they pay for the ingredients. The only thing they have to pay a tax on in this case is the profits that they made off of this product. So when we think about someone like Amazon, right? When we think about Amazon and their retail sector of it, right? So Amazon's retail, that is the stuff you buy. They really don't make much of a profit off of it. The main part of their profit is going to come from their web servers and data. So for Amazon, again, when you buy something off of Amazon, odds are they're not making much of a profit off of it, so it's really not going to contribute much to their tax bill or their corporate tax bill. Right? You still pay a sales tax and all that good stuff, but the corporate income tax probably not going to be super affected by this, because their actual products, that is the junk you buy on Amazon, has a relatively has relatively small margins of profit if they're even making a profit at all. So we have our corporate income tax, which is that charge to corporations. Then we already kind of talked about our excise tax, but it's still here. So this is going to be some tax on people who, whoops, a tax on a specific good, right? So we have things like gasoline, tobacco, alcohol. If you buy cigarettes, you have to pay a certain tax on it. For gas, one of the things that comes up often is, well, why is gas so expensive? And if you look at gas prices, they kind of seem random, right? That is, just because one place is so close to a refinery doesn't necessarily mean that that's where gas is cheapest. So when we think about tax, gas, again, how come gas in Iowa is cheaper than Illinois or Missouri is cheaper than Iowa, whatever the case is? A large part of that could come down, I shouldn't say could, does come down to how much of a tax does how much of an excise tax does each state charge for a specific good? In this case, gasoline. If gas is always higher in Iowa than Missouri, we would expect that Iowa charges a higher tax on gas. The same thing with something like tobacco. Uh, if Missouri charges a lower tax on tobacco, odds are, if Missouri consistently has a lower price on tobacco products than Iowa, odds are they're going to have a lower um, they're going to outright have if they consistently charge lower prices for tobacco products in Missouri than Iowa, odds are Missouri's going to have a lower tax rate than Iowa, because that's where that difference is really going to come in from. So we have our excise taxes. And the last big one that gets charged by the federal government is, we call it the estate and gift tax. And when it's phrased like this, it sounds nice. But when we actually think about what this is a tax where people a tax on people who pass assets on to the next generation. So this is either after death or in forms of gift while they're alive. The other phrase for this estate and gift tax is called the death tax. Right. And the weird thing about this one is that uh if I phrase this as an estate and gift tax, it's going to come across as very favorable. People like that, and it's not anything that people are like, oh, that's a terrible idea. But when we call it a death tax, people have a different attitude towards it, because then it's, well, right, my grandpa just died, and the first thing that you want to do after my grandpa died is make me pay taxes on it, on or on their if my grandpa died, it sounds bad, because the first thing you want me to do is go out and pay taxes on on his estate, or on what got passed down to his family. One note with with this is that you have an exclusion up to $15,000 a year. So every year, your parents, your grandparents, you can pass $15,000 on to somebody else. Um, so just a couple things. So that's our estate tax, otherwise known as a death tax. Again, this is where they say, this is why when they say the two things you can't avoid in life are death and taxes, and even after you die, you get taxed. This is the tax that they're referring to when that discussion is had. Oops. So we have our different types of taxes. As we keep moving down, we get our our state taxes, and I have a couple that I'm going to throw on. The first is going to be oops. Okay. First is going to be called the sales tax, and we're probably familiar with this. This is a tax on the sale of goods. In other countries, this may be called a value-added tax. right? So if I go to McDonald's, I buy a cheeseburger, I buy a sweet tea for $1, I end up paying $1.07. McDonald's gets $1, the government gets 7 cents as a sales tax. We see this. This is one we see all the time. Really, nothing surprising with it. It's 7-8% of the sales we do. Oftentimes, we will have exceptions on sales tax. That'll be for what we deem as essential. So you don't have to pay a sales tax on milk, water, unprepared foods, or anything like that. So sales tax, we're probably fairly familiar with that. And this next one, and the last tax I'm really going to dive into right now, is our property tax. And a property tax, basically, what we do is we tax the value of land, house, or possessions. So if you're ever thinking about buying a house, one of the things that you need to consider when you decide where to move or how much to buy is how much of a property tax am I going to have to how much of a property tax am I going to have to pay after I purchase this house? And that's one of the things that, especially us, we're kind of in the housing market for our first house, but we're not we're in that market. But one of the things that we notice is one of the first things that we actually look at when we see a house is, right, we check it out, we say, all right, how's the house look? How's everything look with it? But then we get on Beacon and look at the property tax for it. Right. So we say, well, if we get this house, how much of a property tax are we going to spend? And oftentimes it can actually be a lot of houses around us are in that $1,500 to $2,500 property tax range. So right, so it's not and that's per year. So it's not something that's just $10, call it good, right? It can be fairly sizable. But again, if you have land or a house, you pay a property tax on it. Another area that we don't necessarily think of as a property tax, but it kind of is, would be your car registration. So some states will outright say your car is they will treat your car as property and tax it as property, whereas here we call it a car registration. Again, two in the same. Um, but when we think about this again, in general, the more valuable your car, the more it's taxed. So again, your car is something that we have a property tax on. Um, States will also generate. So these are state sources of income. States will receive revenue from the federal government. So currently, one of the things with one of the parts of our coronavirus stimulus package is a $600 a week for those who are unemployed. So if you're drawing unemployment, you're going to get an extra $600 a week from the federal government. So for this, what's going on is the federal government is going to give $600 a week to the states. Then the states are going to pay that out in addition to your regular unemployment check. So federal government can send money into the states. You can also get this through your infrastructure bills or a lot of other things meant to funnel resources in to the states. Just like the federal government, your states also charge personal and corporate income tax. When you file your taxes, whether you've already done it or you're going to do it before July 15th, right? Whenever you decide to do that, if you're filing this year, you're going to have to file a federal return and a state return, right? Because you pay taxes to the federal government, then you pay taxes to the state government. Then we have fees and charges. So this can be things like these fees and charges can come in the forms of tickets, maybe ordinance violations, and so on. So during the winter, one of the things that gets posted around town and gets posted on the radio is about people having their sidewalk shoveled, right? And specifically the city sidewalk that goes past your house. They say it needs to be shoveled. If you don't shovel it, we're going to charge you for someone to come out and shovel it, but also an administrative fee. So in this case, the administrative fee is going to be revenue for the city government. So if you violate an ordinance violation, again, the city kind of gets, city or state or whoever's jurisdiction you're falling under, uh, generates revenue from that. So again, these are state, local deals, kind of where they fall in, and so on. And then our next little bit, give me 2 seconds to see where we are. We have policy and policy. So what I'll do for today is I'll introduce the deficit versus the debt, and then on Monday, we'll get into our policy and see how our policy works and so on. So we'll be done a little bit early today, but that's all right with me. And it's not really a big deal. We'll be good on time for this chapter, so I'm not super concerned. But next little bit we have looks at deficits and debt. So when we think about our deficits, one of the things that we talked about was this deficit, and that is the difference between what we bring in tax revenue and what we spend over a fiscal year. Or we could have a surplus, but most of the time it's a deficit. So in this case, again, we say how much tax revenue did I bring in, how much did I spend, and I look over a year, meaning over 1 year is what the deficit refers to. The other word we hear about often is going to be called the national debt. So with the national debt, what we're looking at is how much have I borrowed over time, right? Or how much accumulated debt has been borrowed over time. So we think about this in a personal example. So if we think about debt versus a deficit. This month, so let's think about like our actual spending. And depending on what your situation is, you may have a different situation. But this month, if you are able to keep your job and you are able to keep working like normal, you have your normal paycheck coming in, right? So personally, we have our checks are coming in like normal. We haven't been really overly impacted by the whole thing. Some people have, if you work at a grocery store, you're a nurse, if you're a teacher, right? And if you're a teacher, depending on maybe where you are, but in our case, we're still working just because we're working from home, but we're still working. But so this month, a lot of people have had their paychecks cut, so I'm not neglecting to reference them. But a lot of people are working like normal, right? They're working from home, but they're working like normal. So we're making our normal paycheck. But there's nothing to spend your money on, right? So whereas normally maybe we'd go out and go see a movie, go to a hockey game, go do this or that. Now we're kind of just, over the past month we have eaten at home a lot more than we normally do. We've gone out a lot less than we normally do. So our spending has been down big compared to normal. So if we think about our deficit in this case, a deficit looks again at individual months or time periods. So if your spending goes down for say 1 month, you may say that you're running that may lead to a surplus. Or if there was some sort of shock, so say that you're in the other boat where you have a job that is quote unquote non-essential. Understand I'm putting quote unquote quotes around it because to you it's essential. But you have a non-essential job. Again, I'm air putting in quotes. I know you can't see those. So we have this non-essential job, right? And this is a person who they have a job that's deemed non-essential, so they don't get to go into work, or maybe you have your hours cut, whatever the case is. So on the other side, if during an individual month, if your revenue, say, goes down for that same amount of time, you would have an increased deficit. Right. Again, we're looking at one individual month for the deficit. For our debt, we are going to take the sum of our deficits. Um, so, uh, so say this month we decide to make a large purchase, right? And this large purchase is, say, more than it makes it so that this month as a whole, we actually lost. If we added up everything in all of our bank accounts, we end up losing money this month, right? In that case, we ran a deficit this month, but that negative is going to add to our debt. And if you happen to have, say you have $30,000 in debt, then as you work towards paying this off, or as you work towards increasing it, maybe you have $30,000 in debt and you go out and buy a new car for $20,000, right? So as we work towards paying this off or adding to it, debt is going to look at how much have I had a deficit in total. So just a quick little example of this. Suppose in 2016 we had a deficit of 500 billion. In 2017 we had a surplus of 100 billion. Then in 2018 we ran a deficit of, say, 200 billion. When we're looking at how large is our deficit, what we're going to do, again, each of these years is a deficit or a surplus. But when we think about how large is our deficit in whole, we're going to add our deficits and subtract our surpluses. So in this case, and assuming we started with no debt, started with 0, just to keep things simple. So in this case, in 2016, we ran a $500 billion deficit. So we started out with that deficit of 500 billion. Then we ran a surplus of 100 billion. So we can subtract 100 billion. Then we ran another deficit of 200 billion. So we add that 200 billion, and our total debt in this case would be 5 minus 1 is 400 billion plus 200 billion. And this gives us a total of $600 billion in debt. In life, maybe in 2016, say you graduate this year, right? So in 2020, you graduate. You graduate and you go out and you buy a $20,000 car. So in this year, you run a $20,000 deficit. So at the end of this year, you have a debt of $20,000. But then say in 2021, you're able to run a $4,000 surplus. And in 2022, you're able to run, say, a $2,000 surplus. That means me as an individual am making more money than I'm spending. So again, if we think about this on a personal level, in 2020, in this year, I took out a car loan for $20,000. So my total debt, up here I should have said how large is the debt. My bad. So in this case, my total debt will be equal to basically my deficits minus my surpluses. So in this case, I started out with a $20,000 deficit. Then I had a $4,000 surplus. Then I had a $2,000 surplus. So my debt now is 20 minus 4 is 16, minus 2 is $14,000. So in this case, at the end of 2022, I still have $14,000 of debt. Even though in 2021 and 2022, in those individual years, I was able to pay off some of my debt, I'm still in debt at that point. So on next week, on Monday, what we'll look into more is this is kind of what's going on with spending and how that spending can relate to us. Next, on Monday again, what we'll look at is, or if you want to join in tomorrow, you can do that too. But on Monday, what we'll look at is more of our policy side. How does policy work? What types of policy can we do? and what are some challenges that come with fiscal policy. And that's what we'll do then. And I'm going to get this recording and